In the past week, we've had headlines on China scream concern about its plunging inflation. In essence, it's disinflation or deflation, while others report with alarm that its export surplus has now reached almost $1 trillion. The story in China is pretty straightforward. For decades now, China has produced far more than it has consumed. So it has had to rely on both robust exports and increased internal demand to consume or purchase all that it produces. However, in the last couple of years, internal demand has fallen, might even say collapsed, largely because of all the overbuilding that has brought a series of collapses such as Evergrande. So that leaves the country even more dependent on exports. But international demand for China's product has been flat. So what do you do in that circumstance? Well, they slash prices. They've really had to slash prices to try to engender or stoke additional international demand. Well, there's a consequence for price slashing. That has meant that China's corporate profits have plunged. China's corporations fund those losses through what else? Massively increased borrowing. And China's corporations are now borrowing twice as much as their U.S. counterparts. 142% of GDP in China as compared to 74% corporate borrowing to GDP in the U.S. And China's price slashing is the very thing that is causing its CPI and PPI to be so low. China's CPI is down to 0.2%, which is remarkable. And its PPI is now negative 2.3% and has been negative now for almost 3 years. Because China is a big exporter, it is in effect exporting these low prices to the world. If you were using the vocabulary of an economist, you would say it is now exporting deflationary pressure to the rest of the world. Now, in a freer market like the U.S., there'd be a limit on how much price slashing a U.S. corporation would be willing to do. And if they did that after suffering losses for at least some period of time, it would be a U.S. corporation would be more likely to simply just reduce volumes and stop the bleeding.